Nicole, Abbott Laboratories is a stock that you've been looking at. It's one that you kind of like right here. It should benefit from Obamacare. Is this going to be like a hospital or an HMO play as well?
Yeah, you know, everyone's talking today, what are the plays off of the Obama election win? And actually, big pharma is a sector that's not really going to move, wouldn't have moved much one way or another. Abbott is in a unique situation because it's breaking up the company. That split is going to be effective on January 1st. It's splitting into a pharma business, which is a little bit slower growth, higher dividend, and then it's medical, higher growth medical business, which will have a 20% plus EPS growth. And we've continued to highlight these on Mad Money. Stephanie Link owns it for the Charitable Trust because breaking up really creates value, allows shareholders to invest in either a growth or a value play, and allows each company to focus on its target areas. So we like it here.
Now, the company also just recently reported disappointing earnings, and they discontinued one of their advanced pipeline drugs. Are these concerns that we should be worried about, though?
Yeah, you know, this one is interesting here because of the pullback. It did announce a disappointing quarter. Growth projections for the split were a little bit lower than investors had hoped, but everything now is kind of priced into the stock. And this isn't a pullback like we're seeing in some of the managed care companies where people are worried about profits and in regards to regulation, what's happening now with Obamacare, people kind of scurrying up. This is something that is in the past. The drug that they discontinued is one that wasn't really in a lot of analyst projections already because their expectations weren't too high for it. So this is a really great time to come in. On the pharma side, we also have Hep C, an upcoming conference, which is a really great catalyst. Abbott's a leader in the space along with Gilead, which is another name that we've liked on Mad Money. So definitely the pullback is one of the reasons to come in here.
It's also got a nice dividend yield here. They've paid the dividend for over 40 years, keep increasing it. But now with taxes potentially going up on capital gains, is that a concern?
Yeah, you know, that's a very good point. I think that people are worried about the dividend yielding stocks because of dividend taxes possibly going up, along with capital gains taxes. I think that it's interesting, Bank of America and Morgan Stanley both came out with reports looking historically at different tax change implications on dividend yielding stocks and found that actually there wasn't really much of a change. Right now, consumers are looking for more income-oriented types of stocks. We have the baby boomers that, again, are more income-oriented than growth-oriented. And if these companies continue to have strong profits and strong growth, and you can still get some yield, even if the tax rate's a bit higher, they should continue to perform well. And we've seen that from looking back at historical examples. So the dividend factor is one that you shouldn't worry too much about. And with the split up, the pharma part of that would be the one with the 4% dividend yield. The medical part would be the higher growth segment if you wanted to go that route instead and wanted to stay away from the dividend. So Abbott's definitely a great name right here going into that catalyst.